898,000. That is the number. It is not a statistic. It is not a rounding error. It is a confession. The US government just quietly admitted that 898,000 jobs they spent the last year bragging about, jobs that supposedly proved the economy was booming, never existed. They were ghosts. For 12 months, the headline screamed growth. The stock market rallied on the strength of the American consumer. The Federal Reserve kept interest rates high, labor market supposedly too hot, but it was all a mirage. Strip away the noise. Look at raw data from the Bureau of Labor Statistics. The reality is terrifying. They revised the numbers down. They erased nearly 1 million paychecks with a pen stroke. To find a revision this catastrophic, you must go back to 2009. Exactly 1 year in history. Think about that. Last time government overestimated economy this much, global financial system was melting down. We were in the depths of the great financial crisis. This is the 2009 signal. They are telling you without telling you that the system is broken. Headline numbers buy time, keep you calm. Insiders exit the building. They pump markets with fake optimism. Months later, when nobody is watching, they issue the correction. But you didn't need a government report to tell you this. You felt it. You saw now hiring signs vanish. Price of eggs and insurance skyrocket while your paycheck stayed flat. The data is finally catching up to your reality. This massive revision explains other red flags. Look at bankruptcies. In 2025, total bankruptcies spiked 11%. That is 574,000 businesses closed. That is the highest level since 2010. Look at delinquencies. Americans are defaulting on debts at 4.8%. We haven't seen stress like that since 2017. The economy isn't growing, it is suffocating, and yet the yield on the 10-year treasury is sitting flat at 4.18%. The bond market is confused. The stock market is in denial, but the smart money, the capital that actually moves the world, is not waiting. They are running. When the paper economy lies, wealth flees to the only asset that cannot be printed, revised, or deleted. It runs to metal. But here is where the story gets strange. If you look at the price of silver on your phone right now, you are being lied to again. You might see a price of $82. You might think, okay, silver is high. You are wrong. That number on your screen is the paper price. It is a fictional value derived from trading digital contracts. In New York and London, it represents a promise of silver, not the metal itself. To see the real price, the price that tells you the system is running out of inventory, you have to look east. You have to look at Shanghai. In China, the game is different. They don't want a digital receipt. They want the physical bar. And right now, the Shanghai Gold Exchange is screaming that there is no silver left. Traders in Shanghai are paying premiums of $22 to $40 over the spot price just to secure physical delivery. Think about the mechanics of that. In a normal market, if silver costs $82 in New York and $120 in Shanghai, a bank would simply buy it in New York, fly it to Shanghai, and pocket the difference. That is called arbitrage. It keeps prices equal globally. But that isn't happening. The gap is staying open. Why? Because the metal isn't in New York to ship. The vaults are empty. The Western banks are selling paper contracts backed by nothing, while the Eastern markets are draining supply. This phenomenon has a name. It is called backwardation. In a healthy market, you pay more for something in the future because of storage and insurance. Today's price should be lower than next year's price. Right now, we are seeing the opposite. People are paying significantly more to get the metal today than to wait for tomorrow. This is the ultimate distress signal. It means the market does not believe inventory will exist in 6 months. It means get it now or never get it at all. The inventory data confirms the panic. Shanghai silver stocks have collapsed 88% from their 2021 peak. They are down to just 318 tons. That is vanishingly small for an industrial superpower. And the United States knows this. We are seeing a massive geopolitical shift almost nobody is reporting. The US is actively intercepting silver concentrates from Latin America. Supply that used to flow freely to Asia to feed their factories is being rerouted north to plug holes in the Western supply chain. This is not just inflation. This is a resource war. The West is desperate to keep the illusion of the paper price alive. If they lose control, the bond market crashes, and the currency collapses, so they suppress the paper price while physically starving the East. But you cannot print silver. You cannot revise a shortage of physical atoms. The disconnect between the fake economy, the one with phantom jobs and paper silver, and the real economy is about to snap, and the breaking point has a date. It centers on the COMEX, where these paper games are played. We need to look at the mechanism of failure, because the math for March 2026 is impossible. You have to understand how the COMEX actually works to see the trap. Think of it like a massive warehouse. In theory, for every paper contract sold, there should be a physical bar of silver sitting on a pallet waiting for the owner to come pick it up. That is the theory. The reality is a fractional reserve scam, exactly like your bank account. Since October 2025, that warehouse has been emptying at a terrifying speed. We have watched the inventory drain by 38%. We went from 167 million ounces down to 3 million. Every single day, bars are leaving the vault and not coming back. Now, look at the claims against that dwindling pile. This is where the math breaks. Right now, looking at the March 2026 contracts, the open interest stands at roughly 340 million ounces. There are 340 million ounces owed to traders. There are only 103 million ounces available. That is a 4x oversubscription. For every bar of silver held in vault storage, multiple investors may hold contracts representing claims on that same metal. This structure is common in futures markets, where most contracts are settled financially rather than through physical delivery. While this system works under normal conditions, it can create stress if a large number of traders suddenly demand delivery at the same time. In a purely physical marketplace, limited supply combined with high demand would push prices sharply higher. Futures markets, however, operate differently. Exchanges allow contracts to be settled in cash when physical delivery is impractical. This mechanism helps maintain market stability, but it can frustrate investors who expected to receive metal instead of currency. Imagine a trader who buys silver futures as protection against currency weakness and intends to take delivery. If the exchange offers a cash settlement instead, the trader receives the dollar value rather than physical silver. This does not constitute a default, it is part of the contractual structure. However, it can weaken the link between paper contracts and physical supply, especially during periods of high demand. Recent delivery demand has drawn attention from market watchers. In some months, a larger than usual number of contracts stand for delivery rather than being rolled forward. When more participants request physical metal, suppliers face tighter logistics and inventory management challenges. Silver supply is global. Major producing countries such as Mexico and Peru play central roles in mining output, while refining and manufacturing demand is concentrated in industrial hubs across Asia and North America. Trade flows shift frequently due to logistics costs, refining capacity, and geopolitical considerations. Price differences between regions can emerge when supply chains tighten or industrial demand surges. For example, premiums in Shanghai have risen during periods of strong industrial demand, reflecting local supply constraints and transportation costs, rather than a single global shortage. When price gaps appear, traders may attempt arbitrage, purchasing metal in one region and selling it in another. This activity can help balance supply and demand, but it also increases pressure on inventories when demand is already strong. At the same time, institutional investors have expanded interest in critical materials beyond traditional precious metals. Exchanges such as CME Group now list futures tied to rare earth elements used in electric vehicles, electronics, and defense technology. This reflects broader concern about supply security for strategic resources. Economic signals also influence commodity demand. Rising bankruptcies, slowing growth, and weakening consumer spending can shift investor behavior toward tangible assets. During uncertain periods, market participants often prioritize assets they can hold directly, rather than relying solely on financial claims. Futures markets periodically face moments of heightened stress, particularly around contract deadlines when traders must decide whether to roll positions forward or request delivery. If unusually high numbers seek delivery simultaneously, exchanges may rely more heavily on cash settlement mechanisms to maintain orderly markets. Seasonal factors can also affect trading patterns. During the Lunar New Year holiday, trading activity in Shanghai Gold Exchange slows significantly. temporarily reducing Asian physical demand. Historically, lower liquidity during holiday periods can contribute to short-term volatility in global markets. When trading resumes, demand often returns quickly. If prices decline during the holiday period, renewed buying can tighten supply and restore equilibrium. Contract deadlines, such as first notice day for delivery months, represent key decision points in futures markets. Most traders close or roll their positions before delivery, but a higher delivery rate can signal stronger demand for physical assets. Inventory levels and open interest ratios are closely monitored by analysts. While tight inventories can create pressure, exchanges and suppliers use multiple tools, including sourcing, leasing, and cash settlement, to maintain market functioning. In times of economic uncertainty, investors reassess risk. Currency depreciation, inflation concerns, and slowing growth can increase interest in precious metals. Gold, in particular, has historically served as a store of value during periods of monetary stress. If inflation rises while economic growth slows, a condition often called stagflation, policymakers face difficult choices. Lower interest rates may stimulate growth but risk higher inflation, while higher rates may stabilize currency values but slow economic activity further. Commodity markets during such periods can become volatile rather than moving in straight lines. Sharp price swings may occur as traders react to economic data, policy changes, and supply disruptions. Market professionals often emphasize the difference between owning a contract and holding a physical asset. Contracts provide exposure to price movements, while physical possession removes counterparty risk. Each approach carries advantages and trade-offs depending on an investor's goals. Periods of financial stress can produce temporary price divergences between futures markets and physical retail markets. Similar dynamics were observed during the London Metal Exchange nickel market disruption in 2022, when trading was halted amid extreme volatility. Economic revisions, employment data adjustments, and rising loan delinquencies may affect consumer spending power. If living costs rise while wages stagnate, households can experience financial strain, further shaping demand patterns across the economy. The broader takeaway is that market structure, supply chains, and macroeconomic conditions all interact to shape commodity prices. While uncertainty can create risks, it also encourages investors to better understand how markets function and how different assets behave under stress. Rather than reacting to short-term volatility, many experienced investors focus on diversification, risk management, and long-term resilience. Understanding the difference between paper exposure and physical ownership, monitoring supply trends, and staying informed about economic conditions can help individuals make more informed financial decisions.